Welcome back. You're watching Investors Guide on ET Now. Like we promised, Dhirendra is still with us in our Delhi studio, and we're going to review the HDFC Infrastructure Fund. Now, before we go across to Dhirendra, Avan is here, and she joins us every week to give us an introduction into this fund. Avan.
If you're looking for exposure in the infrastructure sector, then our fund in focus today, the HDFC Infrastructure Fund, could be a good bet for you. Launched in 2008, HDFC Infrastructure Fund is a 3-year close-ended equity scheme that recently converted into an open-ended equity scheme with effect from March 2011. The investment objective of the scheme is to seek long-term capital appreciation by investing predominantly in equity and equity-related securities of companies engaged in or expected to benefit from the growth and development of infrastructure. The scheme aims to invest in sectors like airports, banking, financial services, cement products, and construction-related industries. The fund has given its investors an annualized return of 5% since its inception. Top 3 sectors of the fund are financials, energy, and construction. Let's bring in some numbers to get you a better perspective on the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 1,158 rupees today. But is this a safe bet? Should you add this fund into your portfolio? Our experts are here to give you a peek into just that.
Thanks, Avan. Talking about HDFC infrastructure funds, we've talked about infrastructure funds a lot. We know that among equity funds right now, infrastructure is the lowest performer. But talking about this one in particular, how are you reading into this performance?
It's just another infrastructure fund, better among the lot. But not to forget that this is a closed-end fund. It has had the additional burden of the initial sales charge, which was allowed then and was levied on this fund. So despite that, it has been a reasonably well-performing infrastructure fund. But one should not be in the infrastructure space in the first place. It is proving to be a big test of patience for investors. A lot of money came into these funds, and I think today when the amount of money mobilized in infrastructure fund itself is proving to be a big drag for this segment, because every time the funds are able to recover, investors pull their money out, and that apart, it is not really, it's not a theme which has worked out very nicely for investors, and it is not a huge compromise. If instead of an investor putting his money in HDFC infrastructure, compared to that, if one would have put money in HDFC top 200, HDFC equity, or a big lineup of even a balanced fund, one would have generated a far superior risk-adjusted performance. Maybe in HDFC equity, it would have been 20% annualized return since the start of this fund on a relative basis. So why get into anything unproven, something which is a compromise on diversification? And nothing prevents a good fund to be tilted to infrastructure funds, infrastructure stocks when it wants to.
We've been saying this for a while, that you should look at equity diversified funds instead of infrastructure funds. But infrastructure just seems like that theme that investors find exciting. So for someone who wants that infrastructure exposure, who's interested in investing in infrastructure, and I know you've been studying this off late, how should an investor approach infrastructure right now?
One is that, resist your temptation to approach a theme. You don't know much about it. There is too much of talk about infrastructure, but look at what is the underlying portfolio. Eventually, funds invest in stocks, and infrastructure is very loosely defined. I would say that just overcome this this temptation or this urge to be chasing something which is a fashionable theme. It may not be good for your money, and if at all you do it, if you think that there is a momentum, then you should do it as a medium-term, short-term investment, that you see that there is something playing out, a particular, these funds are doing a little better in a brief period of time. Tilt your portfolio, have a defined allocation, and have an exit plan. And this advice is only valid for the investors who want to get out, who are currently invested in this fund. They should consider exiting this fund. They should be out of the exit load, which would have been applicable crossing 3 years. Very likely, of course, one has to look at the fine print. I would say that it will be worthwhile to get out of this fund and be into, switch your money to HDFC equity or any other, a diverse fund.
That's right. And finally, to put it in a nutshell, your rating, your star rating of the HDFC Infrastructure Fund?
I would give it a 1 star for the kind of expense levied in this fund and despite despite assuming higher risk, it has not the way it has performed so far.
One star there for the HDFC Infrastructure Fund on Investors Guide. We have a couple of other questions that have come in for you. Mr. V. Chandrasekharan has written in from Chennai. He tells us he will be retiring this year in October. He has a retirement benefit of about 20 lakh rupees. Now, he has a monthly pension of 20,000 rupees, whereas his monthly commitments will be about 35,000 rupees. Now, he wants to know what he can do, A, to beat inflation and bridge that gap. So, what should he be doing with that money right now?
Bad news for him, because if he has 20 lakhs worth of retirement benefit and all of it is invested, assuming that his additional income requirement from investment will be 15,000 rupees a month. Even assuming he's able to stagger that, he gets that money less periodically on a quarterly basis, and investing his 15 lakh rupees into senior citizens plan, because his need for this income will be almost guaranteed, predictable, without any compromise. So that will also generate 1,35,000 rupees a year at 9%. So that is one. The other is the remaining 5 lakh rupees. If he invests in balanced fund, he can be hopeful of beating inflation, but his monthly income requirement of 35,000 rupees a month will still not be met. He'll just be getting 2,000-3,000 rupees less. That's one. So I think in the initial years he should work towards lowering his expenses at least by 5,000 rupees. For his money to in balance fund to accumulate from where on. So that could be investing his 5 lakh rupees, reducing his expenses a little bit. So his investment in balance fund could be a good hedge against inflation, and he can draw his regular income from the additional investment in the senior citizen plan, which will get him 9%.
Alright, Mr. Chandrasekharan, like Dhirendra said, unfortunately you're going to have to cut down on your expenses a little bit for now, so that you can invest that money in a balanced fund, and through that balanced fund beat inflation in the long term. But then moving on, we have a question that's coming from Nikhil. He said on the show last week, you mentioned that once you've accumulated money to put down as a down payment when buying a home, a liquid fund would be a good place to park that money. He wants to know from your point of view, what are the best liquid funds to invest in right now?
Oh, liquid funds are fairly straightforward. You really don't need my advice. Liquid funds operate in a very narrow range. They are mandated by the law not to have a security which has more than 91 days. So I would say just choose a fund which you feel you're more little conversant with, or your bank or your advisor is able to provide. The best performing liquid fund and the worst performing liquid fund, the difference won't be more than 10 basis points.
Alright, Nikhil, we hope that helps. Remember, you can get back in touch with us if you need anything else. Dhirendra Kumar, thank you so much for joining us on the show and answering all of our questions. Remember, if you have questions for Dhirendra, you can write into us. There's an email ID at the bottom of your screen, or you can reach us on facebook.com/investorsguide. It also has archives of our show in case you missed anything on this show. On the other side of this break, we're going to be chatting with the management of Experian. Now, that's the second credit bureau that India has. We're going to talk about how it changes your life as a borrower to have two credit bureaus functioning in the market at the same time. So don't go anywhere.